Hi, everyone, and welcome again to another edition of The Week Ahead. As always, I'm joined with my esteemed colleague, Dominique, in Los Angeles. How are you doing? I see that you're not currently at the farmer's market this time.
No, I went out last night, so the farmer's market will be a bit later this week.
Okay, yeah. We also skipped the farmer's market here in London this morning. So let's kind of dive into the past week. And as we consistently saying now that the market obviously were super volatile. I would say Thursday to me seemed one of the most volatile days I've seen in probably since 2008, 2009. Incredible turnaround. And then not that much change on Friday, and we saw a massive sell-off again. So clearly, as everyone says, positioning is light, stuff is getting moved around. Quantitative trading is certainly kind of pushing on positioning, and clearly to a point Thursday, that was amazing. I saw on Twitter, Lloyd Blankfein, the former CEO of Goldman, made a comment saying, if I told you exactly what was going to happen on that CPI number, you would have lost a massive amount of money if you had that knowledge ahead of time, which is very true. So first, let's kind of dive into your kind of take from the data, Fed speeches, comments, market reaction, anything else for the previous week.
So the data makes more sense to me than the market reaction. So shall we start with the data then?
Sure. Yeah.
So basically things are proceeding as I thought, and as we discussed last week. CPI, goods price inflation continuing to stabilize, services price inflation accelerating. So one thing that was a bit dissonant was the Atlanta Fed showing a small decrease. The Atlanta Fed median wage showing a small decrease relative to last month, but data is volatile. Broadly speaking, things are going as I thought. The one thing that was interesting and we discussed last week was the impact of oil prices on inflation expectations, which we saw on Friday. And, as we discussed, this was something the market had not focused on. And, the fact that at least if you live in America, you can see gas prices go up when you fill your car. So that had been going on for about a month. People had not paid attention. It popped up in higher 1-year inflation expectation in the University of Michigan survey, and that was one of the reasons for the sell-off. Yeah. The rally, I think there was a rumor at some point of negotiations between Ukraine and Russia, which could have played a role in the rally, and of course, they turned out to be only rumors. On the Fed, I think there's something quite interesting going on there, which investors definitely need to think about. And that's the fact that I think we are pivoting in the discussion. The pivot is from the policy pivot, if you will. So the idea is that the Fed has to stop because money, as Alex said in our debate, which by the way I really enjoyed. Alex is such a great guy. Policy works with lags. So at some point you should stop, or slow at least, and look at how much damage you've already done and how much more you need. So that's the pivot discussion. And it's really a sort of a risk management issue because if you pivot too soon, you are just going to fall even more behind the curve. And I think the Fed has finally realized that they are really behind the curve. On the other hand, if you pivot too late, you're going to over-tighten, which I think is a very weird concept because you can only measure it after the fact. But I mean, fair enough. So that's a discussion that's going on. But I think there is another discussion, that is likely to overtake the pivot discussion. And that's the issue of a tactical slowdown in hikes to avoid a major incident on the treasury market. And the discussion, it's important, I think, to make the distinction between, because one discussion is going to be, the first one is going to be driven by economic data. And so far, economic data is supporting pivoting later rather than sooner,
right.
because it's disastrous, frankly. I can't think of a...
The data is strong. Inflation is still pretty strong. So that doesn't...
It really...
The numbers we're seeing right now are not, do not recommend stopping or even potentially slowing, right?
Okay. Right. Well, the second discussion, about managing tactically the pace of hike. This was brought by Esther George, who is retiring at the end of the year, but she's making some really very valid points that, there is only so much that the market can absorb. Look at what happened in the UK with pension funds. Obviously, not as much of an issue in the US, where defined benefit pension funds represent only 10% of total pension fund assets. But the bottom line is there is no liquidity in the treasury market. And at some point, we're going to have a big increase in volatility. And that would be a reason to tactically slow, especially since volatility, liquidity tends to fall towards the end of the year and so on and so forth. So watch out for that discussion, or tactical discussion, but really important.
There is an issue, which is we've seen massive sell-offs in a lot of public market equities. We've seen, certainly for the year, from obviously zero interest rates, but, almost unprecedented moves, sell-offs in fixed income. If U.S. is much less about defined benefit for retirement plans, but insurance companies, pension funds, endowments, these are huge players in financial markets in the US, and they run diversified portfolios. And if you have these huge sell-offs in certain assets, they will look to rebalance somehow. There will be unintended consequences like we saw in the UK, just different. One thing I'm surprised, I'm just going to ask you, I don't want to get off topic too much, but I was reading this morning, the FT, venture funds have raised the most money at this point in the year ever, which sounds unheard of considering, a lot of tech stocks, let's assume a lot of ventures around tech, biotech, are down 30, 40, the biggest companies in the world down 30, 40%, and non-profitable high growth companies are down 60 or 70.
So
this money is still out. The problem is there still seems to be still too much liquidity. Now, I'm sure there's a lag in people committing and the money, it could have been established money.
It's a super interesting story because it is a perfect example. It's a good source of potential volatility and perfect example of how things go wrong when liquidity tightens. So basically what's happening is that private equity is struggling to find things to buy, right? And then they have all this liquidity coming on.
Why are they struggling to find things to buy if most companies are coming down in value, or management, if they're struggling and they need significant investments, they're more open to a lower valuation? Why would they be struggling to find?
So it's not just struggling for things to buy, but comparing the value of public and private company. And what is going on is that PE outfits are starting to buy public companies, which is completely out of mandate. And going out of mandate is typically what happens when you are struggling with performance. And that's typically when accidents happen. So watch that space. It's going to be interesting. So the bottom line is you cannot move from a low yield environment to a high yield environment and move super fast. without things breaking somewhere. And I don't know how, but the story about P, to quote one of Macro Hive's favorite expression, it's not the first rodeo we are. So,
Exactly.
definitely. So
I mean, commercial real estate, I'm assuming, is another one fairly well telegraphed. But I guess, again, if you lined up kind of long-term debt, this is the problem. This is why I think you've been so right. And a lot of people are using the 08, 09, even the 2000, 2002 same playbook where Fed raised rates, the economy slows significantly, businesses, consumers come under pressure. They're not strong enough banks, not a strong enough position. But in most cases, they have the war chest or ability to fund either mortgage payments or high yield debt payments, at least for a decent amount of time. And yeah, the Fed is definitely in a different situation. And I think you've been on this from the beginning, is that you cannot take the same playbook. Now, I don't know what the answer is, because if it takes 7%, let's say it's your point, it takes 7-8%, there's going to be a lot of consumers and businesses, and maybe not bank, but like other areas of the economy that are going to be in a much worse shape because they're just much more sensitive to interest rates. And 8% is like game over for, to go from 0 to 8 is game over for certain industries, like home building or something, or.
Yeah, on the margin. But my point has been all along. So first of all, 8% in real term, it's like 0. And remember, before the GFC, the Fed raised to 5%, 5.25. Inflation was less than 2%. So this was 3% real.
That's your point, and actually Alex's as well, which is a great point. Which is, we can say interest rates at 5%, and like, oh my God, we were at 0. How is everything not breaking? But if inflation is at 7 or 8%, it actually still makes money to take out debt and invest it.
Sure. You just have to be careful where you invest it. And Bilal had a really great article about the performance of carry trades.
I know, amazing.
So, read your Macro Hive dispatches, because that's where you'll get a sense of how you could make money in this environment. The bottom line is that for financial markets, it's going to be really hard. And that's why I think I'm getting all this, protest and, we are all going to die type of reaction. But for the real economy, in terms of cash flow, nominal income, it's not great. People don't like it, but it's more likely than not that unless the Fed really, increases the pressure, people's income is going to keep up with inflation. And so the 7-8% interest rate, it's going to hit demand at the margin. So like if you want to buy a house, for sure, not great. Maybe cars, but car loans. Now you can borrow over 5 years, and you can borrow huge amounts, and it's great business. Look at the results. The banks are, especially commercial banks, because they pay 0 for funding, and then they can lend. I don't know where is a car loan these days. I think the last time I looked, it was less than inflation, maybe 5, 6, 7%. It's fantastic.
Yeah.
So of course, guys like these are they're not happy, but the real economy is going to do fine.
Yeah, it's a great point, because we're in this investment echo chamber so often that we just see everything through the lens of where interest rates or corporate bonds or stocks are moving. That's it. That's often not the real economy, and the market keep getting surprised, like the real economy is continuing to be okay, which has been a mystery, I think, for a lot of people. But you've been right, which is there is a separation, and you have to have your eyes open to realize that, just because Apple goes down 30%, that doesn't necessarily mean that, and people are not losing their jobs, it doesn't necessarily mean that the economy is significantly slowing. Anything else from last week that kind of stood out, you think, or?
No, I think that's it. So in the Fed, so the Fed debate, look at this point that Esther George has made, which is really important. Tactically, the Fed should slow. Frankly, in their shoes, that's what I would do for one or two things.
And again, is Brainard out on a limb in kind of the stuff she's starting to talk about, or themes?
Well, I think
undermining their message? Maybe not, because everyone else is saying the opposite, but yeah.
She was very careful in her speech. If you read it carefully, which is what I do, that's how I spend my time, basically, reading the tea leaves. But instead of saying, I am expecting goods price inflation to slow, she said, it has been expected that goods price inflation would slow. So, which is a nice way of making sure she's distancing herself from, a forecaster being potentially wrong, while remaining enough of a dove. No, I think the doves are really having a hard time because all their hope for slowing inflation are being shattered. And, they have no choice. They told us they would react to actual rather than unexpected inflation. So few policy options there.
Yeah. It's when you're saying that, it made me think, thinking about something which is, the hawks and the doves. The doves, my understanding has been for, let's say, the last 15 years up to this year, a lot of the core kind of ethos of the doves is don't raise rates or support the economy, because low rates or good liquidity helps people on the lower ends of earnings. And it's better for low wage earners. A relatively neutral to hot economy is better for poor people. And I can understand that. But the problem is now inflation is actually the biggest problem for that same cohort of people. So people who were traditionally doves are now hawks, for right or for wrong. Like Kashkari as an example. This guy for years was as dovish, my understanding, as you can be. And then we created all these massive inefficiencies in the world, which we thought something would break. Now I feel like it's getting to a point like, if it's going to take longer and longer to break something, then when it does break, it's going to be that much worse. And, can't go back, but clearly we're not in a great position right now. And the fact that the Fed has to get to 8% potentially, there will be some serious pain. Let's see. So, and then, okay, anything else you're going to say for the previous week?
No, that's the essential.
All right. So as we call it the week ahead, so what is your thinking on the week ahead from need out to reactions, I guess?
Yeah. In terms of Fed, the excitement was this week, really. Next week we have the Beige Book, which is it's not very interesting and exciting usually.
Right.
It's Word. We have a NLP filter we apply. So I hope people will.
A lot of clients actually really, this is kind of, this is this and the recession indicator to the kind of natural language processing tools we were using, which we're kind of continuing to build out.
Yeah. The Beige Book reminds me from when I was a junior economist at the IMF. So I was straight out of college and we had to write the Article 4 report for the United States. And it was so boring. Literally, we had to copy the previous year and just change the exact numbers. And so that it didn't sound repetitive, we didn't copy the previous year, but 2 years before. And I thought I was dying. I mean, I find it very difficult to work on something that's very boring. So
not as exciting as being a Macro Hive and having discussions with clients talking about
different universe.
Yeah, I was going to say, talking about what do you believe the market reaction would be to a nuclear bomb getting set off, which experience we have at least once this week.
Definitely. So we have that. Then we have, the usual contingent of speakers. But I think, the data last week basically sealed the deal for November. The pre-meeting blackout starts at the end of this coming week. And the speakers this week are not going to discuss the December meeting. So, I mean, hopefully we get a bit of a respite from the Fed this week. So the data again, I'm, in my notes, in my week ahead note I wrote, mercifully unexciting. And I hope so, because we could do all with a bit of boredom. But basically, we have supply side data, some regional Fed surveys, which it's very volatile, not that important to me.
Right.
More interesting data is residential real estate, and we're going to get quite a lot the NHAB index, building permits, housing starts, existing home sales, and inventories. And to me, inventories is really the key, and where I check if my view of economic resiliency to a higher rate is on track. And the reason it's important to me is that what's going on at the moment is relative to the collapse in sales. Residential real estate prices are actually quite resilient, even though they have started to turn month on month. Year on year, they are still, in the double digit. And they have been unusually resilient. And again, in my view, this goes back to the issue of the balance sheet of the household, which are very strong. So this time around, households that were thinking of selling are looking at prices or looking at how long it takes their house. They don't like it, so they pull out their listings. And they rent out their houses instead. And you see it very clearly in the data, the listings are falling. And the reason they are able to do that, of course, is because their balance sheet are very, very strong. And
also because rents have gone up so much.
Right.
It's quite attractive yield. I mean, if you took out a mortgage at 3 or 4%, or 3 or 4%, and now you get a net return of 7%, you don't need to sell your house. In fact, it's probably feels like a much better investment than putting in the stock market or even the bond market, maybe.
Exactly. I mean, where you would need the situation where you would need to sell your house, if suddenly you lose your job, which goes back to my 8% call, you really need to get the US economy in a recession to see a significant slowdown in things like demand for housing, and so eventually in prices and in wage inflation. So that's what I'm looking. Otherwise, we have the tick leading.
Why is that? You mentioned why is the tick data, or do you think it's important, and what part of it?
So if you are a FX person like Bilal, for instance, you pay attention to it. It's basically the capital account data of the US. So the US has a set of macro data, which is really poor quality compared with, Korea, for instance, that upgraded after its crisis in the late 1990s. But in the US, you have a lot of idiosyncrasies in macro data. So instead of really seeing a nice monthly current account estimate, they have the tick. And so the tick is giving you, that's basically what it is. It's like 2 or 3 years late. I'm not overly excited. 2 or 3 months, sorry, not 2 or 3 years, 2 or 3 months late. I'm not overly excited by it, but I just have to look at it.
Sure. And what were we saying about the student loan forgiveness plan?
Okay, so there is a pickle there on several dimensions. The first one is still in front of the court, and we are waiting for the court decision whether to suspend it or not. And obviously, the plan of the administration is to implement it before the election. But if the worst comes to the worst, they could still use it as an argument saying the heartless Republicans want to prevent the kind-hearted Biden administration from, extending this forgiveness, which is BS, of course. But that's how they'd like to use it. And then the other issue is how do you input it in the budget? Because it's like 1.5% of GDP, the cost. So are you going to put it in last year's budget deficit, in which case, I'll have to raise my estimate by 1.5%, or are you going to put it in this year's? And this is still being debated, I think. And so the Treasury is unusually late in releasing its estimate for the deficit last month. And it's in part a legal issue because there are rules on how you account for things like debt forgiveness. And I guess uncertainty on whether the court will let it proceed or not. So technical matters that I shall explain when more information is available.
Okay, awesome. Anything else for next week or?
No, keep an eye maybe on the G7 discussion on the cap on Russian oil prices. What a disaster this has been.
Yes.
No, I think that's about it.
Okay, awesome. Well, thank you again for another, awesome conversation. And as we kind of started to do recently, just to highlight for our Prime users, we had a couple of great things. John Tierney had a piece looking at supply chains issues, some of those coming undone, some of the problems are being alleviated, but a lot of companies, including companies like Nike, obviously Amazon's talked about in the past, now having inventory issues as over preparing for the amount of demand. I understand like Amazon is trying to get ahead of the Christmas season and kind of being clearly the go-to place for buy Christmas gifts. So this should be interesting to kind of, it's a great article by John Tierney that people should check out. As the piece we started doing the last kind of couple of months, I guess it tops maybe 2 months, which is really putting together every week our top trades for our Prime users across crypto, ETF sectors and equities, FX trades, and then just general asset allocation. So again, for investors, traders, wealth managers, it's a great piece to check out. Again, I was just looking through this super cool piece, looking at stable coins, which, part of the attraction for stable coins, even for more traditional financial companies, was to get this yield, say dollar denominated, pegged to the dollar, an extra 3 or 4%. But these stable coins are struggling to continue to give this kind of benefit over traditional, say, US T-bill rates or yields. And then there's also a lot of kind of cannibalization or attempted cannibalization between like USDC, Binance Coin, other stuff going on. It's a great piece by Dalvier. And then for our professional clients, thank you as always as well. We had a couple of great pieces, as Dominique, you kind of touched on, Bilal's Macroscope, which is kind of the 30,000 feet kind of weekly piece. If you look at it, it's kind of funny twist on, we think, the 60/40 portfolios never had a start to a year like it has. So for diversified investors and anyone looking to take real risk or risk on type trades, basically all of those obviously haven't done well. Obviously not saying every owning a government bond is a big risk on trade traditionally. But actually there is a trade, or there is a strategy which has done very well this year, especially on a vol adjusted basis. And that's kind of FX carry. And it's a super cool article, especially for hedge fund managers, even kind of more active bank traders. And then the other one I was looking at, which kind of been kind of my view, and I guess it kind of dovetails with Dominique's, which is, inflation in Europe is as high or higher in some different ways of counting it as it is in the US. Everyone called, Europe to be in a massive recession, but that hasn't really happened for now. And now places like Germany announcing massive kind of financial support for energy, in some ways kind of selling calls on the price of energy and electricity, how high can bond yields go? And that's a super cool idea. And it's also kind of making us kind of change our view of what we think the right trade is in Bund. So please check that out. As always, I speak for myself. I'm sure Dominique, you as well. Wish all our investors an awesome weekend wherever you are in the world. Please reach out. I definitely feel like I've been getting a lot more people emailing me or pinging me on Bloomberg the last few weeks, I guess, because we're telling people they should. But we'd love to get feedback. Also, we'd love for people, for our Prime members, obviously, to join the Slack room. It's been getting a lot more active and heated lately, especially on questions about LDI in the UK, obviously government, UK politics, but just general stuff. It's just a great thing, and really excited to see that kind of interaction. People should check it out. And if you hadn't seen, we are giving an awesome offer, I think, just for a couple more days, for a 60% discount on our annual Prime offering for kind of more retail wealth manager investors. So please check it out. Thank you, Dominique. As always, have an awesome weekend, and good luck to everybody.
Thank you, Andrew, and good luck, everybody. Talk soon.